Hey everybody, Jeff here. I have a special guest all the way from our Los Angeles office, Mr. Eric Shaw.
Jeff, thanks for having me. This is so exciting to be here in Connecticut in January.
I don't know about January, but there is snow on the ground.
There is. My kids would have loved it.
Too much. So thanks for coming. Rick, we are going to have an awesome discussion today. Thanks for joining.
Happy to be here. I'm just in a good mood because my Eagles are going to the Super Bowl. So fly, Eagles, fly.
I am not going to respond to that, but away we go. So, it is our first episode of the new year. A ton going on. We have a new president. A new president in the short week that he's been in office has made a ton of waves. Now, of course, we're focused on real estate finance. And the burning question is there a way we can get more houses? Is there anything that the president can do to maybe lower the price of housing, but at least let's get some inventory going? Rick, what have we seen so far and what do we have coming down the road?
Well, I guess the good news is that the president has identified housing as a key area where he'd like to see some form of price reduction in some manner. And that's the fact that there's a focus on housing and housing costs is probably a positive sign. In fact, housing was identified in an executive order that the president signed shortly after taking office about reducing prices in terms of the cost of living across the board. But as we've talked about in the past, there are some limits to what the federal government in general and the president, any president, specifically can do when it comes to housing. And I know we're going to talk a little bit more in detail about some of the options that are out there, but an awful lot of what goes on, particularly in terms of supply and new development, does get decided at the local or state level.
So, one of the things that we keep hearing about is the constant drumbeat of regulations and the ability for maybe the federal government at least to step in and say, we're going to clear the way so that development can happen. I'm not sure how that pot of soup is made, whether it be state, county, local, and of course the overriding federal regulations. But it seems to me that maybe if the federal government at least sets the tone, others will fall in line.
Well, the executive order that President Trump issued claimed that about 25% of the construction costs of a new property are due to regulatory compliance. And that's probably not an outrageous estimation of the amount of cost that regulations put in. And to your point, Jeff, there are sort of an underlying layer of regulations that the federal government has in place. And then on top of that, you have state regulations, and on top of that, you have local regulations. So where I'm calling you from today in California, I'm in a state that probably sets the bar in terms of the most regulations you can possibly cram into building almost anything, which will be one of the challenges in rebuilding parts of the Los Angeles area that have been devastated by the recent wildfires. But to your point, I think there's also some tone setting that goes on here. If the federal government can take a good hard look at the regulatory compliance factors they put in play, find places to reduce them a little bit, I think it does set the stage for states and local governments to do the same. And any unnecessary regulations we can pull out that make it a little bit less expensive, a little bit easier for builders to build, really are things that would go a long way toward resolving the inventory shortage that we've had to face for the last 10 years.
Well, what I'm curious about, and Rick, maybe you can talk about this a little bit, is the president does have quite a hand in tax policy and real estate investors specifically, but also just homeowners. Is there anything that he's mentioned or that you're thinking that could come up where that can incentivize either new construction or any kind of turnover?
Really glad you mentioned that. And the truth is that during the campaign, both candidates talked about leveraging tax incentives to entice builders to build more affordable properties, and also to encourage municipal governments, state governments to again lighten up the regulatory burdens and change zoning to make it easier again to specifically build more affordable housing. And I think there's a danger when we talk about lack of supply in general. That's true. We still have relatively speaking, we have a shortage of homes across the country that are available to be purchased. But the most severe shortage is at the entry level, more affordable properties. There's almost nothing for sale for the entry level buyer today. And I do think that combination of tax incentives, tax policies geared toward rewarding states and municipalities for removing zoning restrictions, for lightening regulatory barriers, and then again to incent builders to build these more affordable homes will go a long way toward addressing that shortage. Something that I don't think a lot of people realize is the cost a builder faces before they even break down or break ground. Fannie Mae did a survey a few years back, and this is at least 4 or 5 years ago, where they determined that on average, it costs a builder $80,000 before they break ground to build a new home. And in California, it was over $100,000. So if your table stakes are $100,000 to get started, or even $80,000, hard to see how you build a really low cost, affordable home and still make money in the deal. So whatever relief we can give to the builders in terms of those sunk costs before they get started, hopefully would accrue to the benefit of those first-time buyers looking for something more affordable to move into.
Since we're on the subject of costs of building, we have heard the new buzzword called tariff. Now, I would think that some component of every new home built in America has foreign components to it.
Yep.
I don't know what the percentage is, but my guess is it's significant. And how will tariffs potentially play into that?
Well, in our winter 2024 RCN Investor Sentiment Survey, Jeff, we did ask investors about the tariff question, and they were notably unenthusiastic about the notion of higher tariffs on imported goods. And that's not a surprise. We saw Canadian lumber prices spike a few years back when tariffs were increased there. Lumber obviously is a critical component for both home builders and remodelers and investors who are repairing properties. Over 50% of household appliances are imported. If you have a large tariff placed on those, it makes it more expensive to bring those products in. So there's a lot of concern among builders and investors alike that if we do see a significant increase in tariffs, we're going to potentially have supply chain issues, but we're almost definitely going to see that the cost of building is going to increase. And it's very, very likely that those increases get passed on to the home buyer. So it's not something that will really help those home buyers in terms of lowering prices. In fact, it's likely to make those properties a little bit more expensive. I should point out, though, that tariffs are not exactly a new thing. In fact, if you go back to the beginning of the United States, the first way the federal government funded itself was by imposing tariffs on imported goods. And in fact, we didn't have an income tax until the early 1900s. So for the first 130, 140 years of the United States, a lot of the income that the federal government captured came from tariffs. And even today, before President Trump came into office, we had about a 14.25% tariff on Canadian lumber being imported into the country. So the real question in terms of home builders, in terms of the impact on home prices, is what gets a tariff, what gets a new or higher tariff, and how important is that particular material or product in the overall construction of new properties.
Interesting, interesting. And of course, Eric, the other thing we keep hearing about regarding the components of a home are the labor situation, right? And especially in California.
Yeah, that's a huge percentage of what goes into building a house or renovating a house, and any work that you get done is through manual labor. And unfortunately, we've got now deportations that are starting to happen, if I saw the news correctly the other day. How much of that do you expect to trickle down to our industry?
Yeah, the other major campaign promise that the Trump campaign made was the deportation of undocumented immigrants, and we see that's already started. Although it started with undocumented immigrants who have also some criminal activity on their record, either since emigrating or before they came into the United States. The challenge for the housing industry is that, and the estimates vary, so I'm just going to give you kind of a round number, but roughly a third of construction labor is immigrant labor when it comes to home building. And some high percentage of that, and I don't have an exact number because they're all over the place, but some significant chunk of that immigrant labor is undocumented immigrants. So if that labor goes away, a construction industry that's already struggling to find enough workers suddenly finds themselves in a labor shortage. And that at best means it will take longer to build houses, and at worst means it will take longer and cost more. So there's some real serious considerations when it comes to the impact of deportation in terms of labor and labor costs. The other factor to consider when it comes to labor, and this also holds true for materials to a certain extent, is a lot of what would normally be dedicated to new home building, at least in the short term, is likely to be moved over to home rebuilding. You have entire communities in the western part of North Carolina, in parts of Florida, certainly in Los Angeles, where the wildfires hit, where you're going to want to see fairly rapid reconstruction of those areas. And if you're dealing with, finite amount of imported, materials and products, if you're dealing with a finite number of laborers, all that's going to be diverted away from new home construction just to replace housing that was already there. So, this is all the talk of tariffs, the talk of deportation is all coming at a time when home construction is already under a certain amount of duress, and neither of those things is likely to help the situation very much.
When we think about the labor force, I would think that some of it is geographic centric, right? Like I would think when we think about California, the Southwest, there's got to be a higher proportion of folks that maybe are undocumented than other parts of the country. But by the same token, we also have new construction happening in those areas as well. I'm wondering how that whole pot of soup is going to work out, Rick.
Yeah, I haven't seen any surveys that detail what percentage of labor is immigrant labor or undocumented immigrant labor in different regions. What I can tell you is that most of the new home construction right now is not going on in the state of California. And there's a limited amount even going on in places like Arizona, which kind of got a little overbuilt coming out of the COVID pandemic. Florida construction is slowing down a little bit because suddenly there's an oversupply of inventory. So you do continue to see home building in parts of the South and the Southeast. And just given the geography, you would assume there's a fairly significant amount of immigrant labor that's working on those construction sites. One study I did see a while back was talking about construction in Georgia, and they had higher than the national averages when it came to the percentage of immigrant laborers in the construction workforce. So, not a huge stretch to imagine that all of those states in the South and the Southeast are relying heavily on immigrant labor for home construction.
And of course, the other big component of housing construction is financing. And certainly, the president has made it known that interest rates are too high, and he's not going to stand for it anymore. So I'm assuming they're going to go down. I'm not sure how that happens, Rick, but maybe you have the magic wand to make it happen.
If I had the magic wand to make it happen, Jeff, I would have done it. I would have invited you and all of your friends to visit me on my private island. Um, Unfortunately, I don't have that wand. And in fact, I hate to come across as somebody who's in disagreement with all the president's policies, because I'm actually not. But a lot of what he's talking about doing, and the two things we've talked about mostly this morning, this afternoon, the tariffs and the deportations, many economists view as running the risk of creating more inflation. More inflation would keep the Federal Reserve from lowering the Fed funds rate, which sets the short-term lending rates, but also sort of becomes the basis upon which even long-term rates like 10-year treasuries and 30-year mortgages and private lending are based. So there are some concerns that while the president has campaigned on and is adamant about interest rates coming down, some of the policies that are being talked about may have the opposite effect unintentionally. And I suspect a lot of what we're going to see the president do regarding the Federal Reserve and interest across the board is really going to be resorting to using his bully pulpit to try and swing popular sentiment and swing government sentiment in that direction. But the underlying issue that the bond market has right now, and as you know, bond yields are really what sets lending rates for long-term loans like 30-year mortgages, is we need to get the federal deficit down. The federal deficit right now is sitting at over $36 trillion, all-time record, and our debt payments are actually the second biggest line item in the federal budget. The Treasury needs to continue to issue more bonds in order to pay down that debt. The more bonds you issue, the harder it is to get people to buy them, the higher the yields you have to offer. The higher those yields, the higher mortgage rates are. So it's incumbent on this administration, and we've seen a lot of talk about cost cutting since they've come on board, to get that federal deficit under control. If we do start to see some progress there, we're likely to see bond yields come down and mortgage rates can come down with them. But it's not an overnight fix. It's something we have to keep an eye on.
What strikes me too, and we were talking about natural disasters, and the big component of that, of course, is insurance. Insurance is another, as I talk to investors out there, it's become a very big part of their calculation. How much control, or have you heard anything that's coming out of the administration that can help the situation in places, especially like Florida and California, in Texas, that are having real trouble?
Yeah, about 70% of the investors that we survey with our quarterly investor sentiment survey have identified insurance as being something that absolutely factors into their decision-making process. And over 50% claim it's at least cost them one deal somewhere along the way, either the unaffordability or the unavailability of insurance. We've seen the state government start to step in places like California and Florida, where insurance companies have pulled out. And the government programs have become the insurer of last resort for homeowners in both states. I'm not sure about your situation. I know you're in the Los Angeles area. I'm in Orange County. I got a non-renewal from my insurance company 3 years ago and am now part of the California Fair Plan, which is, by the way, another perfect example of governments naming things exactly the opposite of what they really are. But we'll save that discussion for another day. There are limits to what the federal government can do given the way insurance is currently regulated and issued. Every state has its own Department of Insurance, insurance regulations and policies. California, as bad as things are getting, is probably underpriced in terms of what people are paying for homeowners insurance because of the regulations the state has in place. And while that sounds good for homeowners, it's made it difficult to find anybody to offer insurance if you happen to own a home in the state. So it'll be interesting. I don't think the federal government is going to be able to avoid getting involved in insurance in the long run, because the costs are just exorbitant. We haven't had a year with less than $1 billion natural disaster in over a decade now. And those back-to-back hurricanes we had in Helene and Milton, the wildfires we've had in Southern California, going to be a really difficult year for the insurance companies and the reinsurers in terms of their losses. And those losses do ultimately get passed on to homeowners one way or another. So it's an affordability issue for homeowners. We've talked about affordability historically as the cost of somebody buying a house for the first time. Can I afford to become a homeowner? We're seeing insurance premiums that have gone up nationally 52% over the last 3 years in states like Florida, California, Texas. They've doubled and sometimes tripled in the last couple of years. And so affordability all of a sudden becomes also something you talk about in terms of a current homeowner. I got a 30-year fixed rate loan. So I thought I knew what my monthly bills was going to be when it comes to housing every month. But suddenly my insurance premium is $300 more a month than I thought. So some borrowers can absorb that. Some borrowers who just barely manage to qualify for their loan aren't going to be able to afford that. And I believe we're going to see some of those properties coming to market from people that just can no longer afford those higher housing costs. So insurance is going to be an issue, and I do believe at some point the federal government's going to have to get involved.
So, Rick, when we think about insurance, I just think from an investor standpoint, it really has become a game changer for how investors are looking not only at the local area, but the larger geographic area. If there's so much unknown in Florida and Texas and other coastal areas, I imagine folks are really starting to think about how they're going to plan out their longer term strategy for where they're going to build portfolios.
Well, I think it's a multi-phase decision-making process, Jeff. I think if you're an investor right now, and it's probably less of an issue immediately for a fix and flip investor because they're not planning to hold the property very long. Now they have to factor in insurance costs to their sale price of the house they're going to flip because they need to make sure that whoever is a buyer in that area is going to be able to afford that increased insurance cost. But it's probably again a little bit less of a concern for a fix and flip investor. If you're a buy and hold investor, you're buying a rental property, your first decision process is doing the math because you never used to even include insurance in your calculations. It was just a given. You'd always be able to find it, you'd always be able to afford it. But if it keeps going up 10, 15, 20% a year, at some point this is real money. So you have to figure out if you're going to be able to build that into your P&L going forward. If rent goes up 3% a year and insurance goes up 10% a year, at some point that math doesn't work anymore. And then the second part of that decision-making process, Jeff, I think you're spot on, is where do I invest? Do I invest in an area that is prone to these kind of extreme weather events and natural disasters, knowing that I'm going to have rebuilding costs, and you're never made completely whole by insurance. You're going to have increased insurance costs and all that goes with it. So maybe you start to look for areas that are less prone to extreme weather events. And I was at a conference about a year ago where the determination was that Madison, Wisconsin was probably your optimal place in terms of the least likelihood of extreme weather events. So shout out to Madison. But I think everybody needs to take a look at this because insurance is one of those things where you spread the risk around, and the wider you can spread the risk, the better you're able to absorb losses as they come through, and the less likely you are to bankrupt your customers in the process. So my calculus tells me that at some point the insurance companies have to raise everybody's premiums. And even if you do happen to be in Madison, Wisconsin, there's going to be some fallout for you from the wildfires in LA and the hurricanes that devastated North Carolina, because the insurance company simply can't raise the premiums high enough in those areas to be able to offset all of their losses and potential losses. And again, I think that's why at some point this becomes a federal issue, and the government does need to get involved. Ironically, the president's been talking about disbanding FEMA. And he's been talking about doing that because he believes the states would be better suited to handle local emergencies than a more bureaucratic organization in Washington, D.C., who he also thinks are spending a lot of money on the bureaucracy rather than spending it to help those areas be rebuilt and rehabilitated. So it'll be interesting to see, how that kind of mindset translates into a need for broader insurance oversight across the country.
Interesting. So you're painting a picture of what 2025 holds for us and perhaps the next 4 years. After the election, a lot of my investors in conversations were pretty excited. Here was a president that's coming in who's a real estate professional, and he's going to make everything right. So what positives are we going to see, hopefully, out of this administration?
Yeah, and that's a great point. I'm glad you brought it up. I've been painting kind of a doom and gloomy picture, and I don't mean for it to be quite that bad. And if you're a real estate investor, having somebody who's a career real estate developer in the White House has to be a little bit better than almost any career politician you could have put in that place. Initially, some good news for investors is that the Trump administration is highly unlikely to pursue some of the policies that the previous administration had been talking about. For example, very unlikely we're going to see a massive increase in capital gains taxes. That's really good news for investors who are in this business to generate a profit. It's very unlikely we're going to see rent controls nationally come out of this administration. It's very unlikely we're going to see caps on the number of rental units that an investor can own before they start to get burdened with taxes. So, from a policy perspective, this administration is much more likely to be investor friendly than the last administration was. But there are some other tangible items that the Trump administration could pursue. One of the ones that I know has been fairly popular among investors I've talked to is opening up government lands and government buildings, unused government buildings for development. And those unused government buildings can be converted into multifamily units. Those government lands can solve a land shortage issues that a lot of developers have been facing, a lot of investors have been facing. So those kind of policies can go a long way. Investors are excited about fewer regulatory barriers to building. And the Opportunity Zone program that was part of the first Trump administration, I believe, has been one of the underreported successes of those 4 years. And it was a program where states would identify underserved, underdeveloped parts of their own state, and they would become part of this federal program that allowed people to invest proceeds that they had earned. Rather than paying capital gains taxes, they could invest them in these areas to be utilized specifically for development purposes. And that was true whether it was a residential development or a commercial development. And we saw home sales in those areas go up. We saw the development of commercial and multifamily properties go up. And it really was a win-win. Uh, it attracted capital into these underdeveloped areas and gave investors who'd been successful doing something else an opportunity to defer or reduce their capital gains burden. So it really was a win-win opportunity, and I hope we see an expansion of that. And I'm hopeful we will, because the likely incoming Secretary of Housing was part of that Opportunity Zone program the first time around.
So when we think about some of the initiatives laid out, there is some exciting components, and something that goes all the way back to the first 4 years of President Trump was the thought of taking Fannie and Freddie and privatizing them. I'm quite sure that this is going to come up again, Rick. What are your thoughts, and where do we go from here?
Yeah, the first Trump administration definitely did try to spin out Fannie and Freddie. And there are two reasons why this is attractive for the government. One is that if you spun out those two entities, it would probably raise, and the estimates are a little sketchy, but probably somewhere between 300 and 500 billion dollars in profit for the federal government. That's not small change even by federal government standards. The other is that it would remove $8 trillion of liability from the government's books, from the taxpayers' shoulders, and you would privatize those liabilities. So that's a lot of the impetus for this. Ideologically, this administration is much more in favor of private capital being involved in mortgages than the government having a massive footprint. But that massive government footprint is why I sort of get the heebie-jeebies talking about spinning off Fannie and Freddie, because Fannie and Freddie touch about 70% of all mortgage loans today. If you add FHA and the VA and the USDA into that mix, the government has its fingerprints on about 90% of all mortgages that are active or issued. If you spin these two entities out with the 70% of the market share they touch, you need to do it really thoughtfully and really carefully. You can't just overnight say, via con Dios, you're a private entity now. because you could disrupt the entire market. And unless they're done with some sort of implicit government guarantee, it raises the risk level that lenders have to take on issuing these mortgages, which would likely cause mortgage rates to go up. So I do think philosophically the Trump administration would like to spin out Fannie and Freddie. I think there are some reasonable reasons for doing that, but I think if they don't do it carefully and thoughtfully, and do it exactly the right way, there could be some harm to both the industry and to borrowers for the next few years at least.
I would think like anything that would give the certainty of capital over the long period of time would be good for the housing market. And I just can't help but wonder, does certainty of capital go away if that implicit guarantee goes away? I just can't help but wonder, would it affect interest rates negatively?
If the implicit guarantee goes away, I think you'd see interest rates go up for sure. Keep in mind, Fannie and Freddie were created to ensure a source of liquidity for lenders. The government backstop in the event of failure kind of came along later in the process. And that's really what we're talking about here. I think there's more than adequate capital, both with Fannie and Freddie, and even just in the private markets today, to make lenders to give lenders availabilities to make whatever loans they need to make. So I don't think the absence of capital is a real issue at the moment, but that implied government backstop in the event of problems does minimize risk significantly. And if you do anything to make that risk factor go up, you're going to see interest rates go up along with it.
Maybe this isn't a fair question, but I'll ask it anyway. Do you have an idea about how much of the mortgage rate would be affected, how much it would increase if you were to take away not Ginnie or HUD or anything, but just Fannie and Freddie?
Yeah, I have not done this calculus myself, but the estimates that I've read from people who've been involved in these discussions is uh, at a minimum a quarter point, but it could be as high as a half a point or three-quarters of a point. So the good news is we're not talking about rates going from 7 to 8.5%. But the bad news is in a market where a 7% mortgage makes housing affordable for a lot of buyers, another quarter point, another half a point is a significant difference.
Yeah, there's no doubt about that. So we've spent a great deal of time talking about the incoming president, now our president. Excited about some of his proposals, cautious about others. Rick, if we had to give him some guidelines on what to focus on first, where would we direct him? Let's collectively think about that. What would put gasoline on the fire first, right? Like what would really get this housing market moving again?
First of all, I'm flattered that you think that anything I say may have any impact at all on what Donald Trump thinks or decides. I'm not sure anybody has that kind of impact on him. Maybe Elon Musk, but we'll put that aside for a second as well. First of all, one area for hope is that if you go back to the first Trump administration, the jobs market was incredibly strong. Wage growth was incredibly strong. The economy was incredibly strong. We were really hitting, and the housing market was very strong because of that. We were hitting on all cylinders until that global pandemic hit. And for people that like to do comparison of administrations' performances, I'd encourage you to look at the last time we had a global pandemic and see how we did then. But the first 3+ years, very, very strong. And if we simply have a repeat of that, we will start to see the housing market improve because wages will go up and the economy will be chugging along. So there is some hope there. If I were to encourage the president to do anything right now, it would probably be three things: reducing regulatory barriers to construction, enticing both governments and builders to build more affordable housing using taxes or other incentives. And then the third would be making government land available for building to resolve some of the land issues that we've had.
Eric, as long as we've got you here today and we think about different local initiatives, which in California, I believe it's more of a state initiative, but is the accessory dwelling unit in California making a difference? It was heralded as we are going to open up what's an existing structure on many properties to really get folks into an area where they hadn't been able to be before.
It's hard to say. I don't think on a real measurable basis, it's made that much of a difference. I think there are some areas, especially in California, that lend themselves more to ADUs. The coastal areas that are really densely built, there's not much space to put another unit in there.
Mhm.
So no, in that sense, really didn't do much. Inland, perhaps, it's a way for, and it does work. It's a lot easier for someone to add an extra unit, to pull out the garage and put someone in there as a renter, and do it quickly, which is great. I don't think we're at the point where it's gotten so widespread that it's solved our housing crisis, unfortunately.
Yeah, Rick, I know there's been other areas as well that have thought about this ADU strategy as well.
Yeah, I'm not against ADUs. I think, as you just said, it makes things easier to provide a rental unit on somebody's current property, kind of maximize land use a little bit in those areas. But in California, which probably is the state that could have most benefited from something like this, we just haven't seen enough of them in large enough numbers to make a material difference. But that triggered another thought, Jeff, and this goes back to some of the issues that builders will face with labor shortages and escalating materials and product costs due to potential tariffs. Maybe this is the impetus the industry really needed to start to explore manufactured housing in a more meaningful way. And we are starting to see major lenders and even the GSEs start to provide financing for manufactured housing units. These are not your grandfather's double wide trailers. These are actually pretty significant homes, dwellings that are being built. And my guess also is, as insurance companies start to require homes to be hardened against fires and other natural disasters, you might be able to do a better job of that with a manufactured home than you are with your traditional stick-built on-site construction. So it could be that, whether intentionally or unintentionally, some of the policies that we're seeing talked about today could lead to more of a development of manufactured housing, which again is probably a little cheaper to build, a little quicker to build, and could have some benefits in terms of fighting against some of these extreme weather events.
Well, I'll say this was a great chat today. Eric, thanks so much for joining.
Thanks for having me. It's always good to talk to Rick and to be here with you, Jeff, face to face. It doesn't happen often enough.
No, it doesn't happen nearly often enough. Rick, Happy New Year to you. Good to see you as always.
Fly, Eagles, fly.